Good morning. The three numbers every CRE investor should know to maximize their returns. And if you strip commercial real estate investing down to its core, success isn't about guessing, it's about understanding the numbers that actually drive the value in the equation. And most investors get distracted by surface level metrics or broker performance, whereas professionals, they focus on three critical numbers that determine whether a deal works or if it falls apart. And if you master these and you start thinking like a lender as well as an institutional investor, I hope you gain some knowledge. First is net operating income or NOI, and that's the foundation of the value in a property. So net operating income is basically your income minus your operating expenses before your debt payments. And this single most important number is the most single important number in commercial real estate. And why does that matter? Well, that's the number that determines what your property value is going to be based on an income approach. Markets drive cap rate calculations from there, but it's basically used by lenders to assess the risk in a property as well. So let's give you an example. Say you have gross income of 500,000 and expenses of 200,000 leaves you a net income of 300,000. And a small mistake in expenses can destroy your valuation. So make sure you look at the numbers and audit them to see if they're accurate or reliable. And most deals look good because expenses are understated. And professional investors will go in, normalize expenses, and adjust their own valuation based off of that information for taxes, insurance, management. Two is cap rate is your pricing mechanism. So that definition is your cap rate is equal to the net operating income divided by the purchase price. And that's how the market prices risk. And why does that matter? Well, it determines if you're overpaying for an asset. It helps compare deals across markets in a similar asset class. And it also reflects the asset class risk as well. So an example there is, say you have net operating income of 300,000 for a $5 million purchase with a cap rate of 6%. And Houston's market insights are showing is industrials in the 6 to 7% range, retail is in the 6.5 to 8% range. And office right now is higher with a little more risk premium. So a lower cap rate usually equals lower risk and stronger tenants, and a higher cap rate equals higher risk with vacancy, location, or asset issues. And the pro insight there is that cap rate is not just a number, it's also a market signal. Three is debt service coverage ratio, or DSCR, and that's your lender's gatekeeper. And the definition there is your DSCR is equal to your net operating income divided by your annual debt service. And this is the number that lenders care most about. And why it matters is it can determine your loan approval, but also impact your leverage, so the total loan to value that you're able to get. And it drives loan terms. The higher the debt to income debt coverage ratio, the better the pricing usually is. So an example, 300,000 net operating income, debt payments of 240,000 equals a DSCR or debt coverage of 1.25. And what lenders really like to see is 1.25 or higher. Banks may be at 1.35 and strong deals are north of 1.4. And if DSCR doesn't work, the deal's not going to get financed is the point. So good investors will underwrite to the lender standards before submitting a deal and understand the income and expenses and whether or not they're accurate. And why these three numbers matter when looked at together. Well, most investors look only at one number, and smart investors are looking at three of them at the same time. And here's some thoughts that might help there. So net operating income is really, it determines your income. And then the cap rate is going to determine your value. And then the DSCR is going to determine your financing. So when you look at three holistically, you could miss out and end up overpaying for an asset. Or you could end up underestimating the risk of a deal. Or you could just get your loan declined. So there's really three outcomes there. So next segment is some local insight on Katy, Fulshire, and West Houston. And in high growth corridors like in FM 1463 or along FM 1463 on I-10 West, West Park Tollway, What you're seeing is you're seeing rising net operating income due to population growth in those areas. But you're seeing cap rate compression in retail and industrial, and that means values are going up. And there's stronger debt service performance for stabilized assets in this area. And that's why investors are aggressively targeting, say, retail pads, industrial flex buildings, medical office buildings. So here's the final thought. As part of your analysis, you need to think like a lender as well. And amateur investors can ask, well, how much cash flow does this property produce? Whereas professional investors are asking, does this deal meet lender requirements and market thresholds? And there's a difference. There's a recognition of an outside force in that process. So my call to action for you today is if you're buying, refinancing, or evaluating a commercial real estate deal, let's talk and break down your numbers before you make a move. My name is Bill Rapp. I'm the broker for the EXP Commercial Viking Enterprise Team. We service Houston, Katy, Fulshire, and beyond throughout the United States. Hope you have a good day.